Wake up.
It's your early breakfast
with Africa Milani.
Compound interest is a good thing. When you are investing, you want to get in early, you want to leave your money in that pocket or portfolio as much as possible, and then throughout the years, enjoy the benefit of compound interest. However, there is a dark side to compound interest when it comes to life insurance premiums. And Manus Mostert is a franchise principal and financial advisor at Consult Highfeld, joining us on the line now. Manus, a very good morning and welcome to the show.
Good morning, Africa. How are you doing?
I'm very well, thank you very much. How are you this Thursday morning?
Good, thanks. I heard a little birdie, you just came back from Europe.
I did,
That was
yes.
for vacation purposes.
A bit of work. So the front end of it was work, and then I took the opportunity while I was up there to go visit some other cities I'd never been to before. So it was lovely. It was lovely, I must admit. Now, I will confess that in my years of studying accounting, whenever we spoke of compound interest, it was always almost in a positive light, right? Where you put a pot of money in there, and then over years and years and years, you enjoy the benefit of compound interest. What is the dark side to compound interest on life insurance premiums?
Yes, so you're exactly right. We've got this obviously understanding that compound interest can serve us, but it can also work against us in different manners. But I think to today's topic, I recently attended a seminar where I actually, in my decade-plus experience as a financial planner, I was actually outraged by the stats that they actually put up on the board there to say that the average long-term insurance premium, so if we talk about long-term insurance, we're obviously thinking about life cover, disability, critical illness, those type of things. So the average long-term insurance policy increases by a whopping 12% per year. In perspective, our average salary in South Africa increases by 4.2%. So in your 20, 30, 40-year working career, you're trying to fight something that's outpacing your salary increase by 300%, which is quite crazy to think about.
It is. How do we, I suppose mitigate is not the word, but how do we lessen the impact as much as possible?
Yeah, so look, I think it's twofold answering that. So firstly, I think there's sort of a bit of a transparency problem with product providers, where if you do open the schedule and it shows you your premium projections, it starts out at, for example, 10%, but that's where the compounding effect comes in. So if the consumer asks the question to say, well, how much will this policy increase? The correct answer is 10%, but it's only 10% for that first year. After that, it starts building to 10.1, et cetera, et cetera. And before you see it, you are at a 12, 13, 14, 16% increase per annum. So one of the things is to truly, from the consumer side, is to 100% understand what type of premium pattern you are getting into. So next time you do see your advisor, or next time you do take up a new long-term insurance policy, the correct question to ask is not how much will it increase next year, what is the average increase throughout the term? And I think the other side of the coin is we as advisors sort of get caught in a trap where you see, for example, retirement as in isolation and long-term insurance in another one, where I think from an holistic exercise, you should start thinking about these things as your clients near retirement and go into retirement to still sort of draw up a premium pattern that will be affordable for them as they approach again retirement, but also go into that. And sort of the way to think about that is, and to like really simplify this, is to think about long-term insurance in sort of two categories. So the one you're going to have for the rest of your life. The other part will naturally fall away once you retire. So your life cover, your critical illness, the chances of you claiming that is pretty good. Obviously, we all unfortunately have to pass away. Death and taxes are the only certainty. So you will, at some stage, your family will claim for the life cover. The critical illness, since we're talking about retirement, you usually plan until age 90. Chances are, if you live until 90, you'll probably claim for some odd critical illness as you go along. So those two, typically, you want to keep lifelong. So it makes sense for them to be on a, call it much less aggressive, if you will, premium pattern, maybe increasing at a 6, 7 or 7.5% rate as you go along, instead of a 12 building all the way to 20. But when I say 6 or 7%, I mean fixed at 6 or 7%, not compounding into the future. That would be ideal. And then the second component is the one that falls away in any case. So that's your disability benefits, because that's usually linked to your occupation. So that, you won't keep till age 90. So that's okay if that's on a bit more aggressive premium pattern to make it more affordable, because it's going to fall in anyway. So that's sort of the dark side of the compounding effect of that.
I imagine all of this can be addressed if you are quite diligent at having your annual meeting with your financial advisor, because I know, particularly with the cost of living challenge that everybody's going through, a lot of people were thinking of cancelling whatever sort of assurances that they were putting in place at investments towards their retirement and life cover. And I went, wait a minute, why don't you just reduce your premiums instead of cancelling totally? Because something is better than nothing, because of exactly the concern you're highlighting, where yes, it's 10%, but before you know it, you're up to 15, 16% in a couple of years' time, when you can actually go, actually, this is what I can afford this year. So instead of having it increase at whatever the annual rate is going to be, dispense with that and say, can we make this contribution for every month over the next 12 months, and then review that every 12 months?
100%, you spot on. So that would probably be my first piece of advice, probably a bit cliche coming from me, but having that relationship and conducting regular needs analysis and reviews on your portfolio is crucial, because then you've got the opportunity, and when I say regularly, at least once a year, or if there's any big life events, because like you say, instead of premature cancellation, which ultimately I think a lot of people fall into, especially without the assistance of a financial advisor, they'll look at a policy schedule and they'll think about something and say, I don't need this, and they'll cancel that, and Murphy is going to come then. So my best piece of advice would be to sit regularly and often with your financial advisor and balance your needs with existing cover. So when you start reducing certain cover with the intention of lowering the premium, to ensure that you're going into this with an open mind to understand exactly where your problem areas are, so that we don't take too much from the one thing and put it somewhere else. So part of the review would be, again, to balance the needs versus your existing insurance, ensuring you're not overinsured, keeping up with big life events, because obviously as we are a young family with kids, etc., sooner rather than later, they are going to leave the nest. We all have debts, we're paying off debts, so as you perhaps settle a vehicle, obviously that needs to come off the table from a long-term insurance perspective. So that's definitely a key consideration for all the listeners too.
All right. Wonderful and sage advice as always, Marnus. Thank you very much for your time. Marnus Mostert is a franchise principal and financial advisor at Consult Highveld, talking to us about the challenges and the dangers of compound interest when it comes to life insurance. And all of this can really be addressed if you have your annual meeting with your financial advisor and you are able to talk about affordability of whatever your contributions may be. Marnus, thank you very much indeed.